that they're behind the curve and growth starts to slow. And if that happens, I think the market's going to be a little bit panicky. So if it's just a small action right now, some of these big players might be getting out and they might be preparing for something unforeseen out there. And I think that's a really big deal. I manage my risk by starting with the position sizing. And I think that's really important.
Welcome back, everyone, to Risk. I have a very special guest with me today, Mr. Thomas Thornton of Hedge Fund Telemetry. You're a longtime hedge fund industry insider. We'd love to talk to you today about some of your insights into the industry, risk management, etc. So why don't you tell us a little bit about your background?
I started in the markets in the late 80s, worked at Drexel Burnham during, as an intern during the crash. I then got fully involved in the markets in the early 90s and started at a hedge fund in 2000, launched my own hedge fund in 2002. I was then recruited to go to a larger hedge fund here in Greenwich, Connecticut, which I did, and I worked there till 2011. And then I ran the family office for the founder for several years. I've been now writing Hedge Fund Telemetry, which is the research that I put out when I was at my hedge fund, and it involves a lot of technicals. I focus a lot on market sentiment. I have trade ideas. I look at the whole global macro picture. I have guest columnists as well, lots of other stuff. So more stuff coming as well. So that's been really fun.
So I know the hedge fund space has really evolved since the late 1980s. I know that they kind of went through a boom in the 1990s, and it's changed since then. Why don't you give us an overview of the landscape of the hedge fund world?
It used to be very few of them in the early 90s, and then it became a strategy that, with many strategies within the hedge fund world. Mine was a long-short fund, mostly equities. We dealt with credit as well. There's multi-strat funds. There are funds that are credit-oriented, event catalyst-oriented, driven portfolios, arbitrage. You've just got numerous ones out there. And in the early 2000s, it was just a heyday for hedge funds. And it was really very easy to launch a hedge fund at that time. Barriers to entry were very low. Two guys in a Bloomberg could do it. You just get the legal documentations, you find the money. The economics were really good then. It all changed though towards 2010, 2011. A lot more compliance was required. There were some notable insider trading controversies and scandals that caused the barriers to rise. Again, costs went up. Legal costs went up. It was a lot more difficult to raise capital. Allocators really pulled back and moved more towards the larger, super well-capitalized hedge funds.
So I'm going to assume that CalPERS stopped investing in two guys with the Bloomberg.
The thing is, CalPERS has never been and I've met with them several times. They've never been a good judge of good managers. I mean, they're right before the COVID crash, the manager that handled their portfolios got rid of several hedge funds that were volatility based. When COVID hit and the markets got killed, those funds went up 100+%, and that manager no longer works for CalPERS. So the thing is in the mid 2015, 2019, it was very difficult to raise capital, just absolutely impossible. And I get a lot of times where people will say, hey, look, I want to be a hedge fund manager and I want to do this. I want to be a trader at a hedge fund. How do I get in? It's just really difficult to break in for someone new. It really, in many respects, it takes a bit of a connection with someone at the hedge fund that you can, work your way in. But a lot of people say, well, I'm a really good stock picker. I'm really good at that. It doesn't matter. You've got to run a good business if you're going to run a hedge fund. Remember when I was raising money early on for my fund, I had a big allocator from Blackstone tell me, hey, Tom, you guys are really good at your process, but I want to see over the next 2 years your business thrive. I want to see your business be profitable. That was something that really stayed with me because it is a business. And the problem now by raising money is the fee compression has been a big issue. It used to be you get 2 and 20. You get 2% on the amount of money that you manage, and you make 20% off of the profits that you generate for your portfolio. Now that is very difficult to get 1% under management. It's very difficult to garner the 20%. Now there are exceptions out there, and there are big funds that that are getting spun off of other big funds, and they're really doing pretty well. But it's hard. And the other thing is you're competing against the S&P 500, which hasn't been that easy to compete against, especially if you're managing risk and you're not necessarily long the mega cap FANG stocks and you're hedged on something, you're going to underperform. So our strategy at our old fund, we were net short a lot through up markets, and we were positive every single year. And when 2008 hit, we outperformed the market by 4,000 basis points. We were up on the year. So we were really positioned and ready for that risk when it hit.
Are you still net short in your own investments? I know you like to play the short side a little bit.
Yeah, I'm currently and I'm fighting it a little bit. This last move up really surprised me for the magnitude that we've had. There's been a lot of Tesla in there. I'm short a little Tesla. I covered some of my Tesla right when it started to move, and I thought, oh God, this is terrible. I'm going to cover right at the the peak here, and it's going to drop again. But
The last move really surprised me as well. I mean, usually you see some sort of capitulation. I mean, we had a down move, and then we bounced a little bit, and we never had like that outright capitulation, which we normally have. I mean, would you agree with that?
absolutely, I mean, I think that we went 10 months or 11 months without a 5% pullback, closing pullback on the S&P, and we finally got one. And I thought we were going to get a little bit deeper, and certainly it would have been nice to have had the market come down deeper and find some places to buy, because it's very hard for me and my discipline right now to chase stocks that are still overbought and the market's overbought and market sentiment is overloved. It's very hard for me right now to be chasing the market at these levels. Yes, I'm short the market. I'm short some stocks. I've been able to find ideas that work on the short side. Facebook is one. It's been a pretty good short. I've been paired with a couple others. I was short Snapchat, that got killed. You look hard enough, you can find ideas that will break down, and you can find them to short, and you just find them, you buy, you cover them at profits when you can.
What kind of metrics are you looking at when you're deciding what kind of stock to short? Are you looking at fundamental issues within the company?
I'm not strictly only technical. I do look at fundamentals. I do look at valuations. In many respects, valuations don't matter in this world that we live in today until they do matter. So I am looking at valuation. So for example, Snapchat, I looked at that as a short versus Twitter as a long, partly because of the valuation. It just made absolutely zero sense. Why would Snapchat be double the valuation of Twitter? I think Twitter is a better asset that could be monetized better. I think the management is a little bit, let's just say, light and not all there. But I thought Snapchat was overvalued at the levels. And I knew that Apple's new privacy policy was going to hurt Snapchat. And it did. Twitter's gone down a little bit as well, but Snapchat went down further. Facebook went down further. So it's worked out well on a long short basis.
You just mentioned Apple's change in policy. How do you determine an issue like that may be causing another stock to decline? You must do a lot of research.
Well, I read a lot, and I just am observant of what's going on out there. And when Mark Zuckerberg is whining about the new policies that Apple's coming out with, and it became more of a Mark Zuckerberg versus Tim Cook little spat, I knew that Facebook and Snapchat and the other social media stocks would probably have an effect down the road. So look, I'm not a big fan of Facebook, partly because of all the disclosures that have come out. I just feel like people are going to be turned off of what's been happening with Facebook. Social media is a minefield of filth and disgusting behaviors. And when you see these giant social media companies monetize that and really push that towards their users, it bothers me, and it should bother everybody, especially Instagram. I have daughters; they're older than teenagers now, but the amount of teenagers, female teenagers, that have had mental health issues because of Instagram and the body shaming and all the other stuff, very, very troubling.
Sure, that makes sense. So what sources are you reading? I mean, you read a lot. So what kind of things are you reading?
I read, generally I read as much as I possibly can from the mainstream newspapers, from Wall Street Journal through New York Times, Washington Post, Financial Times. I try to look outside and look at industry publications as well. So there's some tech publications that I'll look at. I'll look at the Atlantic for some opinion pieces and things like that. Just I'm randomly thinking of what I've been reading. But I also talk to a lot of people within industries. And while I look at a lot of technology stocks, I have tech analysts in Asia that are on the ground and they're pretty plugged in on what's happening. So I see that, talk to a lot of different people. I talk to a lot of different hedge fund managers. I talk to a lot of different mutual fund managers, and I try to come up with thesis based on all the things that are coming at me. And one of the things that people always say, well, what is hedge fund telemetry? And when I started the company, I actually thought about all the stuff that I would get at my hedge fund from different sell side traders around the street every morning, and all the research that I would have to read very early on. And I would compile all that and find what was most essential for our fund and what was needed for the fund portfolio managers and the analysts to make decisions. So I would get all that stuff, condense it down and then send it out. And that's essentially what I try to do with hedge fund telemetry. And I try to keep a little, sometimes a humorous spin on important things.
One thing that you mentioned is you're really big into sentiment. My personal view is sentiment is everything in the markets. I just like to understand a little bit how you measure that, what you're looking at, and what are the technicals you analyze.
Well, first of all, when I was at my hedge fund, they anointed me for some reason the market sentiment person, and I would have to reach out to all the different market sentiment polls and the firms that did those. So I would, Ned Davis Research is a great research firm, and they have their crowd sentiment poll. And that took, I think, 5 different types of sentiment indicators from Investors Intelligence, daily sentiment index, put call ratios, various things. And I once was out with one of the analysts and we were having drinks, and I finally got him to tell me all the different indicators that they put in there. And one of the things that he said was the daily sentiment index from a guy named Jake Bernstein, based in San Francisco, was one of the best that he saw and used. And so I have taken that data and I get it daily for 45 different markets, currencies, commodities, equities, bonds, and I've put them on charts on our site so we can chart the ups and downs. And now market sentiment, it's important for people to understand, because a lot of times people will say, oh, the market sentiment is, it's overbought, you should sell the market, or it's oversold and you should buy the market. It can stay there. Market sentiment is a condition, and it can stay oversold and it can stay overbought for a period of time. We've had an enormous rush of bullishness over this last year, and it's stayed overbought for quite a while. And if you had just sold that based off of that, you would have just sat there losing money. It's important when you have a trigger that will move the market after being at an extreme level. And we did get that recently, and we did have a move down, but it didn't get oversold. I also like the CNN Fear and Greed, and I like that because it's not necessarily what people are saying they're doing, or if they're bullish or bearish. It's what traders are actually doing, and that has 5 different indicators within it, and it's very easy to understand, whether there's percentage above the S&P above the 50-day moving average, which is something that I look at on all different indices, as well all the sector ETFs. But that one is good to keep an eye on. Now, in March of 2020, when everything was going to hell, the daily sentiment index, I think, got down to 4% bulls, which I think matched the March 2009 low. The CNN Fear and Greed, I screenshotted it because it was there for just a second, it got to one. And so those
Am
are
am
pretty
I to
extreme
assume that
levels.
you went full long at that point?
I actually did. And I tend to be a contrarian, and I like to see when I get to those extreme levels to take the other side. There's a lot more that goes into it than just market sentiment. I had DeMark indicators that were signaling buy signals. And I've had numerous times when I've had this amount of indicators line up on the buy side when everything seems to be going to hell. And I've had clients call me and email me saying, "Are you okay? What's going on with you? What are you crazy?" And no, I'm not. I'm just following the lead that I've watched and used over 20 years. And it's rare that we get them all lined up together. But when we do get them at those levels, yes, I do go fully long. In 2000, March 2020, I think I was 95% net long, and I bought just everything good. I bought everything I possibly could. And I will say, I did get out of things a little early. I did not anticipate 4,000, 3,000 S&P or 4,000 S&P or 4,600 S&P, not at all. But here we are today. And that, I think we're in a place right now where the markets are going to be in a crossroads over the next quarter or two.
Where do you see the markets going? Are they going to trade sideways, you think?
As I mentioned earlier, the if you bought the 4 or 5 main mega cap tech stocks, those are the one. If you're not in those, you've underperformed the market, and you can add Tesla into that as well. Now, I think that dominance is starting to get a little shaky. Amazon's earnings were horrendous. Apple wasn't good. The world is saying, well, you have a new excuse. You have supply chain issues. Look, we've the market's ignored so many different problems. Oh, the China trade war. Well, let's just buy chips. Let's keep buying all the Trump things, the impeachments, the different things that were happening there. COVID. They bought it. The Fed's fully gone way overboard on that, and I think that's going to be a problem. But I think that there's a writing on the wall that there may be a demand issue that's going to start to come into play, and a lack of demand. We're seeing double ordering on a lot of technology products. So instead of a company will put in an order for double the amount of a product, and they'll get exactly the one time of what they wanted. And then they'll start canceling things down the road. And that happened in 2000, where we saw these huge order cancellations because there was a big demand surge, and then all of a sudden things fell off. And then these companies couldn't blame a supply chain issue. They blamed double ordering and the demand falling off. That may be, I may be too early on this, and I'm not necessarily playing it, but I'm also looking at supply chain problems right now. And I'm looking at retailers. And I think that if you look at the supply chain, the retailers are the second to the bottom next to the consumer. And if the consumer has a lot of demand right now and the retailers don't have the product to sell, they're going to have some problems delivering decent earnings. And a lot of these retailers have had the benefit of the doubt climbing this last year. So I think that that's a theme that I'm watching, where it could be a tough retail season for them. And Amazon might be telling you that as well with their earnings. Apple may be telling you that a little bit with their downticking on iPhones. They're shifting some. I think they just today announced that their iPad numbers were coming down a little bit because they wanted to shift chips to the iPhones. I think that it could be more of a demand issue. Their new products, Apple's new products, are not revolutionary. They're evolutionary. I don't need an iPhone 13. I have the 12, everybody. I don't need the 13. It's the same thing, basically. It's just not needed. And I don't think the upgrade cycle's there.
It sounds like you're getting a little bearish on tech. Now, you mentioned the Fed earlier. How much do you look at the Fed? How much do you think they play into this kind of crazy market we've had?
Well, the Fed overdid it in with COVID. The response, way overdone. Powell really capitulated way before COVID, a year before COVID. He came in, he was more hawkish. He was going to rein in some of the excesses of what the Fed had been doing. And then the repo market started to get crazy September of 2018. And then they had to extend that. And the repo market which is the overnight repo market, I mean, there's a lot of people that will say that the Fed bailed out Citadel and BlackRock from some funding, catastrophe that was looming. I don't know. But the bottom line is Jerome Powell changed course in December of 2018 and sold himself to the devil and had to basically be accommodative from there. And then when COVID hit, there was nothing he could do other than print gobs of money and QE unlimited. But now, look, he's in a corner. I think they're too late. And usually the Fed is always too late and behind the curve. So they're going to announce a taper, probably going to be 15 billion a month, maybe more. I think it should be, but they like to do things in small, gradual movements. So 15 a month, maybe they'll finish the taper mid-year next year. The risk is that they're behind the curve and growth starts to slow. And if that happens, I think the market's going to be a little bit panicky. I also think that there is a risk that Jerome Powell may not be the next Fed chairman. Democrats, between the moderate Democrats and the progressive Democrats, are fighting. Republicans are sort of out of it right now, but the moderates and the progressives are fighting. And Jerome Powell may be a bargaining chip for the progressives to say, hey, look, we don't want Powell, put in someone else, Brainerd, someone super dovish. I don't know how anybody could be more dovish than what we have right now. But the bottom line is that may be something that happens. And Powell may just say, you know what, I don't want to be embarrassed and not get the nomination again. So I'm out of here. And considering there's been a few Fed governors for health reasons or, spend more time with the family, whatever excuse, Powell could certainly do that as well. So yeah, I think the
certainly
Fed
seems like they've been setting him up for a fall past month or so, from my view.
It's more fun to be a Fed chairman when you're cutting rates and you're giving the market what they want. And when you have to take away the goodies, it's not fun because then you become target, and you're a target of politicians, you're a target of the market. People don't like that. What should happen is there should be a real pullback. There should be I think rates should go up immediately. I'm not saying jam them so much higher, but I think we need the ability to have that security in case there is a problem. So in case there is another outbreak, we do have the ability to do some more stimulus. There's ability to help the markets in funding if there's liquidity problems. And that's another big thing that I want to mention. So David Tepper, I don't know did you see the David Tepper on CNBC the other day?
I did not know.
So David Tepper, who I have a ton of respect for, I know there are people that read my stuff he might be reading it because some people there get it. He said he doesn't like any markets. I don't like any markets. I just, no, nothing. Stocks, no. Bonds, no. Nothing. And basically, I reached out to a couple of friends that are pretty much in the know. And I asked them, I said, what do you think of what David Tepper's saying? I got a lot of very interesting comments. And it came down to liquidity. And some of these big players don't like what's happening with liquidity in the markets. And everybody, CNBC and all the others, liquidity is great. The Fed's accommodative. It's 15 billion in QE. It's not going to be that much. But if you looked at what happened last week with some of the currency markets and the rates markets, rates were skyrocketing, spiking higher, especially in Europe, in Australia. There's changes happening. And the liquidity was demonstrated to be absolutely terrible. So if it's just a small action right now, some of these big players might be getting out and they might be preparing for something unforeseen out there. And I think that's a really big deal that not many people are paying attention to. But I think, David Tepper, he's not going to come on CNBC and say that if he doesn't really mean it. I mean, he's a very serious guy. He's a very sharp guy. He doesn't need to be the guy that causes the market to pull back in any way.
Can we shift gears here a little bit? I'd really like to talk about your risk management practices. Believe you limit your trades to 5% of your total trading portfolio, and what other things are you doing to keep your money safe?
Well, one of the things that I do is I try to pair up within my trades along in a short idea within the same sector. It's sometimes very subtle, but that's number one, something that I'll do. Number two, manage my risk by starting with the position sizing. And I think that's really, really important. I will start the minimum at 1%. So I'll have a 1% position. That could be a starter position. I can increase it or start with up to 5%. So I give myself that ability, if I'm wrong and I still feel confident about a trade, the ability to add more. And, there's a lot of people don't add more. There's also, I like to add more when I'm right. So it works both ways. But I give myself a 5% maximum sized position. If I'm wrong, it's not going to kill my month. It's not going to kill my year. I'm still in the game. It doesn't matter. I look at stops, let's say, depending on the asset, let's just say I use 10%. Sometimes it's 15%. I will give myself a larger stop range if my position size is lower. And that's partly what I like to do. I have a bunch of stocks right now that I'm not in the money on. I'm short, I'm not in the money. But I kind of look at those as future apples that I'm going to pick off the tree when they're ripe. And I'll get there. I know with what I have that I'll get there. And look, if I'm not, I'm going to jump on my sword and say, okay, I'm out. I don't mind taking a loss on things. I took a loss recently on, the majority of my Tesla position, in the 900s. And I thought, oh my God, I can't believe I'm doing that. But it hit 1200, it was over 1200 yesterday. And I'm just thinking, maybe not so bad. One thing also that I will do, example, if I'm bearish on something, I will buy a put spread on something. So for example, I have a few put spreads currently on Tesla. It's down this morning, and I'm probably going to be taking some off this morning at probably a 2x profit, which will be nice. But having a option and using derivatives, and you basically know your risk. You're defining your risk. So if your risk is $20,000 on a put spread, and the stock doubles again, you know what you lost. And you know what your risk reward is as well, because you're capped at a lower level. Using a put spread lowers the premium that you're paying for. And I do call spreads as well. Same principle. You know your risk if you're wrong. And that tends to be how I manage risk. But everything is fluid. There are times where I'll go over my risk parameters, very rarely, but it has to be with extremes in the market, whether it's market sentiment, whether it's indicators that are triggering exhaustion signals. March of 2020 was one I was way exposed long. I mean, I was margined, 150% long. It was a kind of a interesting couple of weeks, but it worked out.
Yeah, definitely. I'm sure it did, knowing what happened with the markets. So when you're buying an option, are you buying strictly in the money options, or are you looking at out of the money? What time frame are you looking? Near term expiration dates, long term expiration dates?
Well, it can vary. Depends on the catalyst. One of the problems I have with trying to say I'm going to go 2 months out, or I'm going to go the next month, is that you have weekly options. So everything has become a little bit more chaotic around weekly options. And weekly options, the balls are very high on some of them. And so you have to be very cognizant of that. Like, for example, if you have a Fed meeting, you have tons of earnings, and you're buying a weekly option, expiring on Friday, you better be really careful. I tend to buy put spreads or call spreads 2% out of the money, and then look for a delta on the other side of around 10. So it's almost like a 30-10 delta for put spreads and call spreads. I will not wait for it to go through the lower strike or the upper strike. I will monetize almost immediately a lot of the put spread or call spread once I start to make money. I don't, I look at it like, you got to monetize. You don't, I'm not a buy and hold. And in this type of market, things can turn so quickly, especially with put spreads, because the buy and the dip people come in, and you're making money, and you're like, I just need one more day, and it could be absolutely wiped out.
Yeah, on the short side, you got to be really quick to get out, because it's dangerous to hold.
The other thing is, once you have a move in your direction, you got to take advantage of the vols that increase and before they decrease. And because if you get a move down, the vols increase, and then boom, it evaporates very, very quickly. So yeah, that's been kind of the play. And I trade a lot of options, and I don't really advertise it because it would just cause chaos with people. But when I'm short, I will sell short-term options against my positions all the time. And that has been really helpful because if I'm wrong, I'm collecting a premium. And if it goes through the strike, I've just taken profit on a short, and so be it.
No, it makes a lot of sense. I'd like you to tell us about your service and what you do. I mean, you mentioned it a little bit earlier, but why don't you go into some of the details?
Okay. Well, Hedge Fund Telemetry. I'm happy to report that we have a new website. I've just spent seven, 7 or 8 months developing it. It's not necessarily I'm going to tell you exactly what to do. It's something that a user can come, look at the market sentiment stuff, read our notes, and interject that into their own process. And there's a lot of stuff that I'm developing as far as momentum models. I have one that people, it's new and people seem to like, where it basically ranks between 1 and 3, 1 being a buy, 2 being a hold, and 3 being a sell, 5 different time frames with some large US ETFs. So a lot of people that are managing money for their retirement account will use the longer momentum measure, and they're not necessarily, proprietary or anything that's just so esoteric. It doesn't have to be if it's working. So people will see that, they can use that, and they're they like that a lot. Now we also have guest contributors. I have some hedge fund managers that will on a weekly basis send in a think like a thought piece and what they're reading, and links to things. We're developing it. We've had energy, a sector analyst, Tracy Schuchart from Shy Girl. She's a contributor, and you can sign up for her weekly notes. And we're going to have technology, financials, consumer, healthcare coming soon. I've just honestly, it's been a Herculean effort to get all the subscription stuff organized and working properly. So we're going to add those soon. So it's really I guess you could say it's similar to the way our hedge fund would manage their proprietary information, their fundamental information, their technical information, and it's in a one-stop place. So we're getting there, and I'm really proud of what we've accomplished. Never thought I'd be doing it, but we are, and it's fun. And I've been able to meet tons of people, and I've got great subscribers and institutional, private investors, people that day trade, people that just want to know more about the markets.
Is there anything you'd like to talk about before we conclude everything?
Well, I'm happy for you with your new channel. I will say that. I think it's important for people to manage risk in these days where I think people have thrown risk and the art of managing risk out the window. There's going to come a time where this market becomes more challenging, and it could be a market that goes sideways for years. It could be a market that stays in this trading range. It could be like the 1970s, where you have inflation that is dictating the way markets react. And I think the last 10 years and the next 10 years are going to be quite different. I don't see the mega cap tech stocks, the 2 billion or 1 billion market cap stocks, growing at the same magnitude of what they've grown in the last 10 years. And I think there's going to be new competitors that come in. There's going to be new sectors that people are going to be very interested in. I think the energy markets are going to be very interesting. Uranium's very interesting. I think commodities, people are going to be trading commodities more. I mean, they already are. You have crypto. I'm agnostic with crypto, and I've seen, these markets go absolutely nuts. And I've seen a lot of my friends, really sophisticated hedge fund managers, become very crypto oriented. I've had people tell me that they don't want to trade equities anymore. They want to only trade crypto because it's a more fluid, easier way to trade. That's their opinion. But I think this next year is going to be great. It's great for us because we like volatility, and I don't want this straight up easy type of market. I want to have the challenges of being able to find short ideas, monetize them, and find, places to low risk places to buy.
It's hard to trade a non-volatile market. It's just a
Yeah,
grind.
it's hard to chase, and that's not in my DNA. And so I know when I'm good, and right now it's a trending market with mega cap names. You can find shorts, they're out there, and there's been dispersion out there in the market that it's underreported, but I'm finding short ideas, and it's tricky, but you can do it.
Thank you, everyone, for joining us for Risk today. I want to thank you again. This has just been a fascinating discussion, and really appreciate you taking the time to come talk to us.
Thanks, Lee.